structure the textbook lays out for how a financial crisis occurs, like what the events are. So just to review what we talked about the last like 2 classes that we actually did this, because it's been a while. The first 2 things that happen are asset price declines and increases in uncertainty. They both kind of drive each other, where you have the asset price decline making people uncertain, and that initial uncertainty like up and kicking off the asset price decline. Doesn't have to be, but usually. Those lead to a deterioration in the bank's balance sheets. So they thought they were well capitalized, that their assets were worth a lot more than their liabilities. As the value of their assets that they're holding on their balance sheet declines, their financial position declines, and suddenly they go from being well capitalized to not having enough capital on hand. All 3 of those things in the initial phase, according to the textbook, leads to adverse selection and moral hazard problems, and they worsen lending contracts. You get issues with incentives, especially if, say the Fed steps in and provides lending to these firms as they're becoming insolvent, or if these firms expect the Federal Reserve to come in and bail them out, which was pretty much implicit since it was like assumed since Continental Illinois failed and the Fed stepped in back in like '87. These moral hazard problems encourage firms to take on more risk because they know they have that backstop from the Federal Reserve. Stage 2, when we go from the initial phase to the actual banking crisis itself, these problems, the deterioration of banks' balance sheet, falling asset prices, they lead economic activity to decline. Because banks are in worse financial positions, they're more hesitant to lend money. They're not lending to each other as much. So banks have to keep more on hand. They can't lend to firms or to individuals, again, because they need to keep that buffer to keep them solvent. As economic activity declines, asset prices continue to decline, banks begin to fail. They become insolvent. They need to get taken over by the Fed, or they go bankrupt. They need to be sold for pennies on the dollar. Banks become more concerned, and they lend even less to each other because they don't know who's well capitalized. And things like the financial crisis, where all these banks are extremely connected, they're all lending to each other. This can be, even one bank being in bad position can be deadly for the system. Everyone stops lending to that one bank, but then everyone else's balance sheet deteriorates because that bank is in bad shape. So it's like dominoes are all knocking each other down. Again, you have problems with adverse selection and moral hazard, and economic activity continues to decline. Then in stage 3, if things get really bad, we didn't really see this during the financial crisis, but during the Great Depression, this was the final stage. There's an unanticipated decline in the price level. So economic activity declines, so firms start laying off extra workers that they don't need. As there's more people unemployed, there's fewer people buying goods and services. So especially for firms struggling to sell goods and services, what are they going to do? They're going to lower the cost, driving down the price level. But as they lower the cost, they're getting less money for these goods and services, so they're in a worse financial position, and they're not able to get loans from banks because banks have decreased their lending. So now they need to get rid of more employees. They're going to increase employment, trying to reduce their labor costs, cause the economic activity to decline, more decrease in the price level to try to just get those goods sold, and it goes down and down in a vicious cycle. Debt deflation can be extremely difficult to get out of when an economy reaches it. So that's why economists are so afraid of deflation, and in any situation. Yeah, so that's the basic anatomy that Michigan gives of a financial crisis. Doesn't quite contain all the details that like the Kindleberger Minsky model does, but that's your basic summary, basic idea. So if you talk about the Great Depression, talk about the financial crisis, or even go into the other financial crises, like older ones, like the South Sea bubble, the Tulamania bubble. You see basically all those going on. Maybe not stage 3, the debt deflation. That's only if it gets really bad. But stage 1 and 2, you see in these financial crises. So now we're back to the Great Depression. This was at this point, the worst financial crisis, the worst depression, the worst everything. Rather than being just isolated in one country or in a few connected countries, this was pretty much worldwide, this depression. So the textbook asks the question, how did the financial crisis unfold during the Great Depression, and how did it lead to the worst economic downturn in U.S. history? There were several causes of the Great Depression. Obviously, when something goes this wrong, there's not just one thing going on. It's going to be a combination of a lot of bad things. So it was brought on by a stock market crash, and this was in large part due to Fed policy. Let's see if I'm, okay, I don't have specific notes on that. Basically, people assumed that the stock market was going to keep going up and up and up. They got this perception in their mind because I think I talked about this last time, just about it was the modern age. For the first time, people were getting all these mechanized products in their lives. People were just getting like electricity. Indoor plumbing was becoming popular. I mean, things that we think are like the most basic, like necessities, were just becoming common in people's lives. As they see this great change, they think like, I don't know, the problems of the past are over. They get this perception that we're in this new modern age. To combine that, or combined with that popular perception, was Fed policy. So all the countries on the classical gold standard abandoned it in World War I. It's really difficult to stay on a gold standard while fighting in a big war because it takes a lot of money to fund a war. So what countries would typically do in the classical gold standard is go off this gold standard for the war, inflate their currency to help pay for the war, and then within a couple years after it was over, go back onto the gold standard. World War I was so big, so bloody, so costly that they spent a lot of money on those wars. And instead of just being able to deflate a little bit to get back down to the old, on a parity with the gold standard, they were so far above it that it would either taken like a long time, like decades to get back at a normal pace, or they'd have to like sharply deflate. So Britain, loving tradition as they do, they decided to go back to the old parity and do it as quickly as possible. So they deflated like crazy. This led to, I don't remember, it was gold outflows. So gold was pouring out of the country, going to other, to be used in other countries. And they wanted to stop this process. So they asked or leaned on the Fed to lower their interest rates to help prevent that, or at least gold from going from Britain to the United States. So the Federal Reserve substantially lowered interest rates at the time, and they were, as people like to say about the crisis, too low for too long. So the Fed had really low interest rates, which helped contribute to the asset bubble. So it encouraged people to borrow, and a lot of people in the 20s borrowed money just to invest in the stock market, which is great when the stock market's going up, but once it stops going up, or once it slows down, you can really be in trouble, especially when a lot of these loans were called call loans. So like the banks could at any time ask for their money back. In 25, 26, 27, when stock market's going up substantially, it's really easy to sell out of your position and pay off that loan. 28, 29, 30, when it's crashing, it's really difficult. And when you do, you're selling it for a lot lower value than of what you were buying it at. Also contributing to the stock market increase was just the return to normalcy. For the first time in, I don't know, like a decade or so, we were back to more of a peaceful world economy. There wasn't a lot of, there were wars going on. There wasn't, I don't know, like alliances that you had to worry about. You couldn't trade with one side or the other. So people were able to spend money like they weren't in the, like during World War I, in the lead up to World War I. Now, once the stock market reached its peak, the Fed finally became aware that it was a bubble, or a possible bubble. So they decided to increase interest rates in order to prick the bubble. Unfortunately, what they ended up doing was causing a massive crash in the stock market, or contributing to a massive crash. There were other reasons why it crashed. Chancellor of the Exchequer, so basically like the Treasury Secretary of Britain, Philip Seymour, called the massive stock increases an orgy of speculation in early October of 28 or 29. 28, he said that. It was repeated in the New York Times like the next day. So this is fairly widely read. The Treasury Secretary at the time, Mellon, he also made a very negative quote about the stock market, saying things were overvalued, that this can't last, which really hurt confidence in the market, and people started selling. And that's one of the things that started like the downward crash in the stock market. Irving Fisher, one of the great American economists, one of the greatest American economists like of all time, he was actually one who developed the theory of debt deflation. He predicted a new normal high stock prices in like the mid-20s leading up to this. So it wasn't just like, common people that didn't know enough. This was like good economists that thought this. He predicted would continue even while the crash was occurring. So even while the stock market is going down, he's like, oh, it's a temporary correction. We're at this new normal, these new high stock prices. And yeah, so it doesn't show the lead up, but we start out like around 1920, like down here. Like basically where it was there, and we see it shoot up. And even when it's going down, like even like here, he's saying that this is just temporary, don't worry. We're at a new normal high prices. But you can see it went from 100 to just 10% of that, of its peak. So he wasn't exactly right. He ended up losing his shirt, pretty much his entire fortune, including his house, because of all the money he had invested in the market. Even John Maynard Keynes, who used the Great Depression to develop his general theory, he lost a ton of money in the stock market crash. This sudden reversal from all this like amazing confidence to seeing the stock market crash like that, I don't know, made people like almost immediately flip and freak out about the market. So you had like Britain pretty much withdrawing from the American stock market, just selling all their stocks and moving past it. The Fed and both the Fed and the Bank of England raised their discount rates to try to put upward pressure on interest rates, even while the stock market was plummeting. And from that, the Hatchery Industrial Conglomerate, which was a big I don't know, manufacturer at the time, they collapsed early on. during the stock market crash. So that was further fuel to the fire. In addition, there was bank panics throughout the country. There was poor. The first problem was during World War I, Europe wasn't producing many crops because they were at war, but they still needed food. So American farmers increased their production of crops in order to sell to Europe. And then in the aftermath of World War I, they were still trying to rebuild. I think there was like a drought or two, like a couple years. So American farmers were producing a ton. Finally, Europe is recovered from the war. They start growing enough food that they don't need American food anymore. So there's a ton of extra, like wheat on the market and corn, like all the stuff we were selling to Europe. Drove down the price of the farming output. All the pretty much all the crops prices plummet, and a lot of them can't be sold. Farmers are struggling to repay their loans, so there ends up being a run on the banks in agricultural areas. Like they talked about money free and unfree, they had the pyramiding of reserves. So banks in these small areas would keep a portion of their reserves at bigger banks in a bigger city. So say all of the farming in the Midwest would send it to Chicago, and the Bank of Chicago would send it to New York. So when those banks failed, the one in Chicago had a ton of pressure on them. They became insolvent. And say there's another one in Texas, one in Oklahoma City, one in Denver that have all the agricultural deposits. A bunch of those goes, and the Bank of New York that has a bunch of their deposits, now they're insolvent. So we have a run on the banks all over the country being caused by the declining agricultural prices. Then following that up, during the Great Depression, after the stock market crash, we had a terrible, terrible drought in the Midwest, usually referred to as the Dust Bowl, where there was just literally no rain. Is that Grapes of Wrath where they go out to California?
Yeah.
Yeah. The one they made fun of in South Park when they run out of internet. Randy takes the family and goes out to California. So that further, deteriorated the economy. Like I said, there's so many things going on. This is just one bad thing after another. You look at the stock market crash in '87. That was bad, but it didn't have long-lasting, broader effects on the economy. But because of other things, like mistakes the Fed made and other random things that you can't control, the Great Depression turned into the Great Depression. The decline in stock prices lasted for a long time. Like we see here, it goes from the peak in late 29 all the way down to 32. That's a long time for the stock market to fall. That helped bring on the debt deflation. And once you get trapped in a cycle of debt deflation, it's really difficult to get out of. Despite all the alphabet soup that FDR created, all the different agencies and the works projects, that still wasn't enough to stimulate aggregate demand, to get enough unemployed people getting money that they're able to spend it and spur on economic activity. Some of it was regulations that were passed that were generally that do not encourage more spending, that were passed in response to the panic in 29. Some of it was just due to all the problems that were beyond their control, things like the Dust Bowl. So for 2 years, so from 29 to 31, there were bank failures, and the Fed pretty much sat by and didn't do anything to solve that problem, to step in and help those banks, even the solid but illiquid ones. Finally, in March 1933, FDR called a bank holiday. And I think it was for a week. he shut down all the banks. None of them were allowed to open, so people couldn't get their money out. But that was to prevent further runs on the banks, because healthy, like solvent banks that weren't liquid and weren't able to get money like quick enough had people like, you know, storming trying to get their deposits out. When he called that bank holiday, that's when the U.S. officially went off the gold standard. Not that the interwar gold standard was really a gold standard, but you could still turn in your money to get gold. He completely cut the ties. By the time they opened the banks back up. I should have put in the meme where the guy's like pointing at his head. Like, you can't have a run on the banks if all the banks are closed. That was like FDR's thought. So from 29 to 33, commercial lending by banks fell in half. So this is an incredible like decline in lending that we see. Investment, like overall investment economy, fell by 90%. So you've got literally no one putting money in the economy. Like, this is trying to invest in businesses. So you see no capital projects, no firms trying to improve their productivity, just do anything to hire more workers. There's nothing. Credit spreads began to jump, so you have a much higher interest rate being charged on these loans to protect the banks from default, and in case the person can't like pay back, or the firm can't pay back that loan. So combined, these all led to the debt deflation. You end up with the net worth and the value of firms, net worth of individuals and the value of firms substantially decreasing from like 28, 29 to like 31, 32, 33. Unemployment was extremely high. They calculate unemployment rate differently back then. I think they used U6 instead of U3. So the number, someone on Fed Challenge, you remember what the U6 number was?
Like, what the actual number is?
Yeah, like 6% or 7%.
Just go.
Look it up quick.
U6. And is it seasonally adjusted or not seasonally adjusted? What was seasonally adjusted?
Yeah, seasonally adjusted.
October 2019 is 7.
All right, 7% right now. So the headline unemployment rate that you always see is U3. U6 is basically what they used to use back then. So you said it's like 7% now?
Yeah.
It was like 25% in the Great Depression. So and this lasted for a long time. It wasn't just like a quick spike that dropped back down.
They don't have to go back that far. Fred.
Yeah, because the BLS wasn't around back then.
I'm looking at Fred now.
Oh, you're looking at Fred?
And let me go back to 1994.
Yeah, they calculated it slightly different back then, but it was basically U6 back then. If you compare like U6 to the unemployment rate in the Great Depression, the Great Depression doesn't look so bad compared to the financial crisis, or makes the financial crisis look worse than if you just look at U3. Just because there's more people included in U6. So like people who are working part-time but want to be working full-time. Yeah, and they include people that are marginally attached to the labor force.
The global financial crisis, it went from like 8.8 at the beginning to 16.5 at the peak.
So it shows like how much closer the financial crisis was to the Great Depression. It's hard to imagine the actual impact of the Great Depression now because of just how different the world is. I think it was in the 1980 election that Reagan quipped that a recession was when your neighbor loses his job, a depression is when you lose your job, and a recovery is when Jimmy Carter loses his job. But even just like losing a job now, like people lost jobs in the financial crisis, but it wasn't life still continued on like fairly normally. Whereas in the Great Depression, it was pretty much like a different world. And those unemployment, like losing your job back then meant, I don't know, things were a lot worse. It's hard to imagine that today. Do any of you guys have like grandparents or maybe like great grandparents that were alive in the Great Depression that like told stories about it?
They're really young. They said that they ate different. No. My grandpa says that pretzels are depression-proof food, recession-proof food. Everybody always has a dollar to spend on pretzels.
True. Can't really argue that.
He said.
Every now and then, my grandpa would call things like depression food, and it was like stewed tomatoes.
Yeah.
He's like, "Oh yeah, that's a good depression food there. That's what we had as a kid all the time."
Yeah, there's like certain foods that they make that's just like they make this when they were kids.
Yeah, that like I would never eat, or never like consider a meal. Like they joked on South Park from the financial crisis episode where like they had like hot dogs without buns and like tomato slices, and they're like, "Oh, that's all we have for food." And like Randy and his wife were like fighting about it. But then of course he went and got a margarita from his Margaritaville machine. That episode does actually a really good job explaining the financial crisis.
Really?
You should watch it.
We'll just watch it in class.
Yeah, we should watch Big Short.
Big Short. That's the one with like Christian Bale and like a couple other guys about them like shorting.
Michael Scott.
Oh yeah, Michael Scott was in it. His character was like annoying but like entertaining. It's been a while since I watched it. I just remember thinking that.
Margot Berry. Is that her name?
Margot Robbie.
Rob.
Is that her name?
Is that who you're talking about? The blonde one?
Yeah, the one in the bathtub.
Yeah, Margot Robbie.
Yeah, sorry.
Or Seth Rogen. Yeah, I mean, they're the same person. Margot Robbie, Seth Rogen definitely look the same. Same amount of hair.
I forget what I was going to say. Oh, when my grandpa because he's 95. So he was like 4 or 5 when the stock market like crashed. When he gets like food like takeout, like he cuts it into thirds and eats like 1/3 and saves the other 2/3 for like the next meals. Because you don't know when you're gonna get food again.
Really?
Yeah, they used to play this game called Cobbs. There was a apple orchard near their house, and like this old guy like lived there, and they would try to sneak in and steal an apple, like him and his buddies, and he'd usually like chase them away, but sometimes they'd get the apple. And when they were hungry, like Cobbs was like calling dibs on like the leftovers,
Oh.
and they would just like gnaw on like the apple cob. They would, I mean, they would like eat like 1 meal a day, like, cause that's all they had. But they still got to live like a house the whole time. You look at like sometimes they like show like realistic movies, and there are people living in like straight up shacks.
Real.
There were all these veterans from World War I that lost their jobs, lost their houses, like lost everything. So they moved like to tents and camped right outside of DC. I'm not sure what part of like what, if it was like Maryland or Virginia, but like right outside DC, and they called them Hoovervilles because they thought Herbert Hoover wasn't doing enough to like help them. Just like the toll that took and like what that meant for people's lives. When electricity and indoor plumbing isn't like, not everyone has it. You got people literally living in like shacks and like
My grandpa
sheds
talks
you'd
about-
have in your backyard now.
My grandpa talks about one of his friends that like a 3rd floor in their house.
Yeah.
It's kind of crazy.
I was watching The Highwayman. Have you guys seen that on Netflix?
Oh, no, is it good?
Yeah, it's got like Woody Harrelson and I'm blanking on the other guy.
You need to watch it.
Two like two like kind of over the hill actors in it, and they're like
They're like Clint Eastwood.
not Clint Eastwood,
He's over
really over the hill.
I don't know.
But they're
Yeah,
chasing
great.
like Bonnie and Clyde, and they live in like Texas, I think. And he goes to Woody Harrelson's house, the other guy. He's a really good actor. I don't know why I'm blanking on his name. Anyway, he goes to his house. Yeah, Kevin Costner, I think. He goes to Woody Harrelson's house, and he's living in like, it was like, all the walls got like knocked off or something, and it's just like boards like tacked up, and you can like kind of like see through the slats. You're literally just like living in the elements at the time. And this was him, I don't know, he lost his job during the Great Depression, was just like chilling there. And it's like, I don't know, a quarter of the size of this room, a fifth of the size of this room, like total. Like that was just like how people lived, like in response to the
Yeah.
which I don't know. It's just nuts and so different compared to like how people, like what happened after the Great Recession. I don't know. Some of that just being due to like being less advanced back then.
I think it's also crazy to think about like how far we've even come in that time, you know, like 90 years.
It's like a totally different world.
Yeah.
Like they didn't have like washing machines back then. Or like most people didn't have cars. Like they'd be like, I don't know, my grandpa said they'd be like surprised when they saw a car drive by. Like it was like a cool thing.
That's another thing, my grandpa tells a story that his dad was supposed to go to the store to get meat for like the week. Like, I don't know, what, he was just, the times before he came back with a car. And
What?
my grandpa's mom was very upset with him. He had to sleep in the car for a little bit.
Holy shit.
I thought it was funny.
My grandpa and his brother would like worked at the golf course caddying. Because like the rich people did well enough during the Depression. You know, like doctors, lawyers, whatever, like they could keep doing stuff like that. So like they worked at the golf course and they would like work for like basically tips. And they get like a quarter a week or something. And my pap's quarter was for ground beef for the week. And his brother Jack's quarter was for potatoes for the week. And that's like what they ate. We got like 10 minutes left. But we'll move on now to the Great Recession. Stock market price and what? Credit spreads. Yeah, so like I said, credit spreads spiked because of uncertainty in the market. The lower credit spreads are, the better. Basic idea. Okay. So, any questions about the Great Depression? That was just kind of like an overview of like how it fits with the model financial crises. It wasn't meant to be like everything that happened in the Great Depression. Does that make sense? Like if I ask you on the final, like, I don't know, give the basic anatomy of a financial crisis, use some examples of the Great Depression, the financial crisis, you could like, I've given you guys enough for that?
Yeah.
Okay. I want to make sure I'm not like being like an asshole, just like not explaining something to you guys and screwing you over later. All right. So it's very easy to like teach about the financial crisis or just talk about the financial crisis and blame the Fed, say that like they were terrible, use it as a chance just for like an anti-Fed rant. You could also blame other financial regulators. You could blame market participants. There's a lot of different people you could talk shit on. But despite how much I want to talk about what the Fed did wrong, it's not like to convince you guys to get rid of the Federal Reserve. It's very important to learn from these previous mistakes that we made. So I had a couple quotes up here from famous people talking about learning from past mistakes. To highlight that that's the purpose of this. Like Plutarch, to make no mistakes is not the power of man, but from their errors and mistakes, the wise and the good learn wisdom for the future. Another one from, I don't know how to pronounce it. It's Van Gogh. Van Gogh.
Wolfgang Van Gogh. He's the Shakespeare of the Germans.
Yeah.
Like, if you Google Shakespeare of the Germans, he'll come up.
His name's gonna be.
I read a bunch of his quotes. He has a lot of good famous quotes, but I never read any of his stuff. And by seeking and blundering, we learn. And of course, by George Bernard Shaw, success does not consist in never making mistakes, but never making the same one a second time. You could say the Fed did that. They went from not lending to solvent financial institutions to lending to every financial institution.
So they didn't make the same mistake twice.
Exactly.
It's a different mistake.
So, Friedrich Mishkin, the author of your textbook, this is a quote from him in August 2008. So when I look at where I was in the March FOMC meeting, I sounded so depressed, as though I might take out a gun and blow my head off. But my sunny, optimistic disposition is coming back. I think there's a strong possibility that the worst is over. This is when the narrator says the worst was not over. This was right before the big crash. There was a view
Did
of
he
the.
kill himself?
He did not.
Shut up.
Probably better that he's still around doing this stuff.
Yeah.
I could say he was wrong back then and like laugh at him, but I mean, the dude is still smarter than me. So there's only so much shit you can talk to these guys before you remember that they gotta, make fun of Janet Yellen for, I don't know, being too big of an inflation dove, but genius, and I'm here. No one really recognized that the financial crisis was going to be that bad, even in 2008. If you look at, I've been reading Too Big to Fail, just to like kill time, and the book is a lot more in depth than the movie. And Andrew Ross Sorkin really shows, like in the first 100, 200 pages, that nobody saw this coming. Even while everything was falling apart, Dick Fold was still trying to tell people that Lehman's balance sheet was solid, and that these toxic mortgage assets were going to come back, which is laughable in hindsight. But none of the regulators saw this coming. No one saw this coming. You can't blame it on Wall Street greed if you want to look at the cause of the financial crisis. That's like blaming an airplane crash on gravity. Greed is always present. You know anything about the people that work at financial institutions on Wall Street, you know that they're always greedy. That's kind of like the culture there. Going back to Adam Smith, self-interest is a natural human desire. So this self-interest, generally good. Greed, a little bit worse. Not the best for society. But the question is, why is this time different? What happened in the financial crisis that didn't happen a week before, a month before, a year before? Why did it happen then instead of 2004? And for that, there's a lot of different things to blame and a lot of different ways to look at it. This right here is a clip from Too Big to Fail, where they go through.
We have no intention of dismantling the regulatory agencies.
However, we must come to grips with inefficient and burdensome regulations. We will eliminate those that are unproductive and unnecessary, tearing down these antiquated walls and granting banks significant authority.
In a victory for the banking industry, Congress has approved legislation which will allow commercial and investment banks to merge and form institutions of unprecedented size and global reach.
I think it's very important for us not to introduce regulation for regulation's sake.
I do believe in the American dream. Owning a home is a part of that dream. We are taking action to bring many thousands of Americans closer to owning a home. This project not only is good for the soul of the country, it's good for the pocketbook of the country as well.
The housing market has reached frantic proportions. It seems that everybody is building, buying, or selling.
The Dow and the S&P both breaking records. Profits soared 93% at Goldman Sachs this year. Hotshot traders and bankers can expect to take home $10, $25, and in some cases $50 million.
Things that are too good to be true are when you see something coming. The real estate housing bubble, don't put it off. Take action immediately.
Will there be a soft landing or will the bubble burst?
The news story, the mortgage meltdown.
This morning in the mortgage meltdown, new numbers showing that a record number of Americans are losing their homes.
More than 70 mortgage companies have failed in the last few months in America, and now the biggest of the big companies, the Bear Stearns, the big banks, are caught holding the bag.
The fifth largest investment bank in the country, Bear Stearns, is
They
being
were-
sold for just
They
$2
were one
a
of the
share.
mortgage companies failing. They were a rating agency. So they were rating the subprime assets higher. Yeah.
It's documented that Hank Paulson didn't think he signed up for this when President Bush picked him to become president.
Hank Paulson will now have to undo some of the deregulation measures that he and his peers on Wall Street pushed through when he ran Goldman.
Double B.
People would ask, okay, well,
Treasury
this is
Secretary
gonna be weird,
Hank
this is double
Paulson
B.
telling
How do we
9
get
Hour
it?
this morning, quote, they're all over it. I've got
Oh,
great
this asset,
confidence
this
in our
asset.
markets.
Yeah.
They're resilient, they're flexible.
Allie, the truth is that Bear Stearns is only a very small fraction of this story. Our economy could face far worse than a recession.
In the wake of Bear's collapse, Lehman Brothers is scrambling to reassure investors about the impact of the mortgage crisis on its own assets. Shares of the firm under a great deal of pressure this morning. Dick Stoll, a 39-year veteran of Lehman and the longest-running CEO of a major investment bank on Wall Street, has pulled the firm back from the brink during other crises. But today, for the first time that I'm hearing it, investors are questioning his leadership. One key
So that gives you the basic, with all the fancy music and stuff. Basically what was going on in the lead up to the crisis. You had a lot of deregulation, a lot of encouragement by the government for the housing market, especially in the subprime market. You had earnings and profits spiking because of their involvement with mortgage-backed securities, all these financial institutions. And eventually, it came to an end. Suddenly, they start failing. These firms start failing suddenly, these mortgage companies, and then it affects the biggest investment banks. So next time, well, I guess Monday, we're going to talk about the last chapter from Money Free and Unfree. And Wednesday, we'll dig into the financial crisis.
Why we won't be here
Why won't we be here?
Wednesday? Will we be here Wednesday?
Well, we have class on Wednesday.
Wait, we don't have class Wednesday, do we?
No, we don't.
Wait, actually, do we? I don't know.
No, we don't.
Oh, never mind. So I guess we'll do it after Thanksgiving.
I didn't think we had class Wednesday.
I don't know. I was planning on working Wednesday, so I just assumed we had classes.
No, we're done.
No, probably it's normally Tuesday, isn't
We're
it?
gonna turn a paper in online.
Just email it to me.